Dheeraj Sachdev, Vice President and Head of Equities. He represents the PMS business for HSBC AMC. Dheeraj, good morning. Thank you for joining us. Dheeraj, how would you characterize the current market environment? Do you think it is time to buy into this weakness, or currently long-term investors should exercise some patience and this market will give better entry points as the year unwinds?
Hi, good morning, Nikunj. Well, Nikunj, it is difficult to time the market. We have seen historically, timing is a futile exercise. And I think the strategy should be to buy on dips. Our view is that over the next couple of months, at least in the short term, the market may have to cross the hurdles, specifically like the winter session of Parliament, because in September and October, the markets rallied from 5,200 Nifty to about 5,800 on pronouncements by the finance minister and the government on raising of FDI and bringing down the fiscal deficit, etc. So there were reforms announcement. Now the actual execution will be keenly watched in the winter session of Parliament. The other hurdles that the market may have to cross, which have come from the global side, is the US fiscal cliff and how it pans out in terms of whether the tax raising on the capital gains or dividends there will slow down the growth momentum, and plus the leadership change in China. But barring this, eventually we believe that buy and dips is the right strategy, because early part of next year we might see the early signs of global commodity prices correcting, and also it will pave the way for interest rate cycle to decline going forward. And I think this is the single most important variable for the markets. There's a perfect inverse correlation between the way interest rate movements happen and the markets behave. So we believe the commodity price correction, interest rate declining trend, and much of the downgrade cycle in the corporate earnings being behind, I think it will renew the emergence of a bull run.
Dheeraj, if I rewind all our earlier conversations and most of the conversation I had with the experts in the end of 2011, all of them were hoping for a rate cut in 2012. All of them were hoping for a drop in commodity prices. Unfortunately, that trade has failed this year. What, to your mind, are the chances that the rate cut trade will fail for next year as well?
I think it will be probably low. We might expect rate cut to happen next year. See, last year, all the way till December, we had till December 2011, we had almost 13 rate hikes, and the markets corrected accordingly. This year, maybe there was some kind of a rate cut, and most of the year we saw a pause. So I think the next stage will be the rate cutting cycle. And I think RBI is giving or buying time in terms of rate cutting, because the inflation is still sticky, though it has come to an 8-month low, the last inflation number. So we might see that there is more probability or higher probability of rate cutting rather than pause being extended even into the next year.
Do you think the outperformance in consumer discretionary stocks is here to stay?
As long as the valuations are reasonable, it can stay, but eventually we believe that the cyclicals and financials will outperform.
So, Dheeraj, do you think the polarized nature of the market is changing? It's no longer defensive, it's no longer consumer or pharma. If I look at the Nifty top performers for this year, it's JP Associates followed by IDFC and then Ultratech, and the three stocks which are outperforming, they are not the classic consumer names, they are the classic investment names.
Yeah, cement has been a big outperformer, given better realizations and expectedly better than the numbers that they have delivered in the last few quarters. But yes, I think the market direction is changing. We also believe that the defensives are not attractively priced. They are richly valued, and the shift has to happen from defensives to cyclicals, be it interest rate sensitives like autos, banks. As the investment cycle picks up at a later stage over the next 3 or 4 quarters, people will start nibbling in the industrial side and the capital goods side as well. So I think the market will change directions, because valuations is, as you rightly pointed out, polarized at this point of time.
So Dheeraj, give us some sectors and stocks that you are still recommending to your clients to go out and buy at this point.
Can't talk about stocks, but sectors that we have invested is not largely defensives. We have invested across autos, banks, selective cement, engineering, IT, and large portion into mid caps, because we do believe that the rally will spread across mid caps, given the fact that in the last 2 years A lot of mid-cap companies are under hibernation, and the valuation gap between their large-cap counterpart is at a high. So we do believe that the money will shift towards mid-caps and the recognition will happen. Time and again it has been proved that as the rally gathers momentum and matures over time, the spread happens deeper down and outside the index. So we believe that the recognition will happen on the mid-cap side as well.
Right. Dheeraj, do you think large cap FMCG stroke consumer names, they've hit some kind of a stumbling block?
I think the discretionary spend obviously has been somewhat weaker, and we do believe that the valuations are rich on the consumer businesses. So any kind of disappointments will be taken negatively by the market, and on the other side of the market appears to be attractively priced from a price to book or ROE perspective, which includes the cyclicals. So yes, from a risk reward perspective, FMCGs will see some kind of relatively underperformance compared to other sectors.
Dheeraj, you've talked about autos, banks and mid-caps. Talk a little bit more about what your preference is when it comes to the broader markets.
So it's very selective stock picking because, but we have to be diversified. Obviously, the economy offers a wide variety of businesses and sectors to choose from, thankfully. So you have mid-sized IT companies also reporting fairly decent set of numbers. Mid-sized banks which are reportedly doing well. Selective private sector banks doing much better. Public sector banks may have obviously given or reflected higher NPA levels and restructured assets, but much of it is in the price at 0.6 times, 0.7 times adjusted book values. And India being a capital-starved economy, I think banking business is a sustainable growth business. So you have a variety of sectors and stocks to choose from based on the valuation, quality of earnings, ROE, etc. So broadly, we are very stock specific.
Right, Dheeraj, identify a group or a group of stocks for us which you've been owning from last 12 months and you plan to stick to that position for next 12 months regardless of global cues and the macro environment.
Well, we generally hold the stocks for a fairly degree of time. It's not just a group of stocks. But as you pointed out, I think we have select banking stocks in the private sector where we believe sustainability appears to be there. And we may retain our large overweight position in select private banks where the valuations are still cheaper at about 1 time or 1.3 or 1.4 times. It could be regional private sector banks. It could be select high quality banks.
Dheeraj, I'm scratching my head. I'm trying to remember which is one private bank which is available at 1 time book because I have a list of banks in front of me. I cannot spot a single one.
Well, you really have to figure that out. But there are a host of private sector banks. It could be regional banks where it's still available at 1.1 to 1.3 times book and available at an ROE of 22-23% with good amount of dividends distributed to the shareholders at 3 to 4%. So I think, yes, they are available. You have to spot it.
Last time when we interacted with you on this forum, you were bullish on engineering and auto ancillaries. What's your take there now? Now that auto dispatch numbers have been strong, are you bullish on auto engineering and auto ancillary companies?
Autos being interest sensitive, we expect that even CV cycle, which has been subdued so far, will start picking up going forward. And auto component, there is a variety of businesses. So we like selective names in the auto component side as well because of increased contract manufacturing or outsourcing. But one has to be careful that they are not completely dependent on the OEMs because they don't have the pricing power and they have a decent amount of replacement market as well. And provided they make a good amount of capital efficiency in terms of 18 to 20% ROE. So yes, we are positive on autos. On the engineering, we believe it will be a lag impact because the investment cycle has indeed not picked up and it may take some time before the investment cycle picks up and engineering and cap goods start performing. So it's a longer term play. It's a gradual addition to the portfolio, but auto component obviously may do earlier, better than the engineering goods.
Dheeraj, so looks like your entire bull market argument is revolving in and around a rate cut. What, to your mind, are the chances that Reserve Bank of India could announce a rate cut, let's say in Jan, and after that they take a pause? What happens to markets then?
We don't specifically view how the monthly announcements from the RBI will be, but early part of next year, even the RBI has guided that there is a higher probability or chances of rate cut. And I think this, if you if you look at the stages in the last 3 years, the first 2 years in the last 3 years has been of rate hike cycle. This year has been a minor rate cut, but most of it is paused. And we believe that the rate cut will happen as a third stage from RBI's point of view, largely because of the fact that one, the global commodity prices will start correcting. Given the fact that for the first time in 4 years, China has announced kind of a slowdown, which never happened before. Also, there is some stability on global commodity prices. Crude, for example, despite the attack on Gaza, it did not react or flare up. So there is some kind of stability on the commodity prices, and in a weaker demand scenario across the Western world and China slowing down, you might see higher chances of commodity prices declining. And inflation somewhat being subdued. For us, we may expect that there is a greater chances and room for RBI to cut rates.
Where are you exactly picking your spots when it comes to consumer names? Because the India romance is the middle class which is spending more, the middle class which is getting rich, and the middle class which is saving less and is now believing in discretionary spend. So how are you playing the Indian consumer?
Well, consumer, you have a variety of names from consumer durables, consumer discretionary companies like air conditioning companies, retailing, jewelry, etc., etc. So we are selecting ideas based on valuations, because in some of the cases and in most of the cases in FMCG or consumer, the valuations are not cheap, and the markets have valued them well ahead of times, and any kind of disappointment will alter the risk-reward situation in consumer names. So it's a variety of basket to choose from, but we do have ownership in consumer durable names, variety of consumer durable names, including some of the consumer jewelry names as well.
Dheeraj, if the India story is so strong, why are Indian markets of late underperforming global markets? If I map how things have moved in the month of November, Indian markets surely are underperforming global markets.
So one has to look at year to date. I think year to date, if China is down about 6 to 7% and India is up about 20% or so, and some of them have, some mid-cap stocks have done much better. So obviously in year to date, India has outperformed and one of the best performing markets compared to other emerging markets. Well, November has seen some kind of a correction. It's just one of the blip of the year to date rally. Also because of the fact that the sharp rally that we saw from mid-September to October because of the announcement and reforms measures, which is a step in the right direction, is seeing some kind of a profit taking, which is acceptable given that winter session is starting, and the market has to witness that these are actually getting implemented at the ground level. So there is some element of cautiousness and profit taking, which is fair.
I'm just going to make a hypothetical case. If the winter session this time is more like a washout, will that disappoint markets or will that surprise markets?
Of course, this will disappoint the market, at least in the...
Do you think markets could crack if the winter session is a washout?
So the cautiousness is already getting built ahead of the winter session, so it will not crack, but there could be some element of, say, 5 to 7% correction possibility.
5 to 7% means Nifty could retest levels of 50-200 or even 50-100.
Oh, closer to that there is a possibility, yeah.
Do you think Nifty could break before 5,000 or we have a firm base there?
I think we have a firm base there now.
Are you fully invested?
Largely, yes.
And what would you buy on every decline?
As I mentioned, the sectors are variety, and we generally are essentially exposed to the mid-cap side of the market. But across sectors, be it auto ancillary, banks, cement, gradually adding engineering cap goods for the reasons that I mentioned, that investment cycle will gradually pick up, selective IT companies.